Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Cem Karsan and I, Niels Kaastrup Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Cem, it's great to be back with you this week. I can't believe we're heading into March already, tomorrow. How are you doing?
Well, we've had a bit of an Indian summer here in Chicago, 70-degree Fahrenheit temperatures. But so it already feels like spring here. And markets kind of already feel like spring too.
Yes, I'm not sure if they're confused about the Christmas rally coming very early or very late, but it certainly has been an interesting period, let's put it that way. Now, as always, when you're on, we have some great topics that we're going to be diving into. And we also have a few questions where people would like your thoughts. But before we dive into all of this, I'd like to step outside of the topics we're going to talk about and just maybe ask you sort of a little bit what's been top of mind on your radar maybe since we last spoke, which was very, very early January of this year, where we kind of peaked into 2024. But since then, outside the topics, anything that have sort of piqued your interest?
Yeah, I mean, I think the big things are it's an election year, and not just kind of what that means from a bigger sense, but from a more micro sense, what that's meaning for the Fed and their choices, what that means for interest rates in this environment, and what that may mean for the broad path of how this thing eventually kind of ends. We've talked about blow off top, but all those things are beginning to connect here in an election year, and I think that's the big thing that's top of mind for me.
Okay, fair enough, and we're definitely going to get into all of that. I wanted to mention one thing that has come across my radar, at least in the last few weeks, as I've been traveling around and meeting with clients and potential clients. And it's a topic that also Bloomberg have picked up on a few times, not least, I think today I saw another headline. And the topic is private credit. And what they wrote, Bloomberg, was they say the rise of private credit funds have been powered by a simple pitch to the insurers and pensions who manage people's money over the course of decades. The idea, invest in our loans and avoid the price gyrations endemic to rival types of corporate finance. This elegant proposal has managed to transform a Wall Street backwater into a 1.7 trillion market. Now, central bank rate hikes over the past 2 years have strained the finances of corporate borrowers, making it hard for many to keep up with their interest payments. Suddenly, a prime virtue of private credit, letting these funds decide what their loans are worth rather than exposing them to public markets, is looking like one of the greatest potential flaws. So I'm just curious whether this is something that you think about, that you come up in your conversations, because it's obviously been an incredibly popular strategy.
Yeah, I mean, this is another symptom of the massive malinvestment. You keep interest rates at zero for long enough, and the starved, masses who need yield are increasingly willing to do things that are not rational in the long run, in the short term. And I think, private credit has grown dramatically over the last several decades, particularly the last 10 years. And much like private equity, these kind of longer duration, kind of not mark to market realities can build and sit there and fester for a while. And we can skate past it, right? To be clear, if markets kind of revert and invert, all those potential losses under the hood can never become real losses. But if we keep going, and again, you and I have talked about the potential for this to be a more secular move, it's eventually it all becomes unsustainable. And I think that's just another symptom of it, not to lump it in with everything else, but it is one of the places that is particularly grown dramatically and particularly, it's everywhere. And it's in every major portfolio. It's being treated not as a risk asset as much as probably it should be.
Yeah. It does surprise me, however, that there's still so much seemingly appetite for this stuff at this stage. But anyway, let's move on. Of course, it is the last trading day of the month of February. So in terms of a trend following update, let me just say, thank God we've got 29 days this year, because momentum and trends have been very, very strong this year. So no, we're not getting any crisis alpha, but boy, are we getting some alpha, which just goes to show that trend followers don't need any trouble in equity markets to do well. In fact, the SocGen Trend Index looks like it's on course for the biggest monthly return since March of 2022. And from where I sit, it looks to me like it's a very broad-based, quote-unquote, rally, so to speak, where all sectors should more or less be profitable. But of course, where we have seen a few standout markets and trends in those, such as cocoa, 29% price move up in February, 126% up in the past 12 months. Japanese stocks up another 9.4% in February, up 45% in the past 12 months. Of course, US tech stocks doing pretty well. Nat gas down 16% in February, down 52% in the past 12 months. And grains, in particular the soy complex and corn, continues to be in a pretty strong downtrend. Now, it may not be a new all-time high for the SocGen Trend Index. We're going to be close, but it sure will be a new all-time high for some individual managers. My trend barometer has picked up. It's going to close, or it closed yesterday at 50. So it is in positive territory, suggesting that CTAs are having a good environment, but it's probably more aligned with the shorter-term trend index, which is positive, but not nearly as strong. In terms of numbers, and these numbers are not as of yesterday, the 28th, they're not updated quite yet, but let's see where it all finishes. It's going to be close. BTOP 50 up almost 5% in Feb, up 6.12% year to date. SocGen CTA index up 5.58 in February, up 6.66 for the year. SocGen Trend up 7.25, up 8.6% so far this year. And the SocGen Short-Term Traders Index up 1.7% in Feb and up 80 basis points now for the year. MSCI World up 3.66% as of yesterday, up 4.84% for the year. World government bonds down, and again, 1.04%. And the S&P 500 up 4.77% and up 6.5% so far this year. All right, let's move on. Let's dive into a couple of topics, but questions I meant to say before we dive into the topics. This is a question that came in for you, Cem, from Rick. Rick writes, in late 2022, during one of your chats and on other interviews at the time, Cem noted that tech was broadly underrepresented, as long-duration assets like tech and bonds had sold off significantly, presumably across the positioning landscape he surveys, and he advocated getting long tech. Now to present day, long-duration assets have been gobbled up in anticipation of 6-7 rate cuts. This is a few weeks ago, of course. In an interview last week, and again, this email came in a couple of weeks ago, he suggested getting long what has not worked of late. My question is, has positioning in tech now gone back to the other side of the boat and reverse of late 2022? And then gold, oil, and the like have not worked recently, hence the question regarding long-dated calls on gold. Many thanks, Rick. All right, Cem, over to you.
Yeah, I mean, there's a couple of things that we've begun to see that I think are important signs. One, as we went through Feb OPEX, we began to see the decay of a lot of the calls in the Mag 7 that had been put on. So as we kind of predicted in those couple of weeks leading into that, we thought we would see weakness. The big question was coming out of that OPEX, right? Would we continue to see that broad weakness relative weakness, not weakness writ large? And we have. And now as we enter March OPEX, that momentum, that general loss of momentum on a relative value basis and that broadening out, as you mentioned before, of performance tends to, given the high volatility that exists in these calls and the open interest, lead to structural selling. So these are kind of those reverse Rana and charm flows we talk about from dealers, and particularly in the periods leading into the OPEX. So March OPEX is a very big OPEX now. And we're about to enter into that last 2-week period where these flows really matter more. And so we believe not only what we've seen really for now almost a month continue, but I think it could really, that rebalance could accelerate in these 2 weeks here. That relative performance, once it gets going, kind of feeds on itself because of these types of positioning flows. So yes, we called for this in late January, and thought that move would start to unwind relative, at least on a relative basis. And we have seen that. We do think that will continue. And the more it happens, the more that can feed on itself. So it's starting to get a little bit of momentum, which I think is important for these things. The vol on those calls is still high. There's still a lot of open interest and adding open interest because people still are hopeful it'll get going again on a relative value basis. And it's a very unpopular call. It has been for the last month, but it's worked incredibly well. And that's always a good sign as well.
Yeah, no, absolutely. Okay, all right. So here are some thoughts, thinking a little bit out loud, but also I think sort of questions, topics that has come in since we last spoke that I just want to sort of give you a chance to comment on. You and I have discussed in the past that there's been a lot of media attention on the 0-day option stuff. And I think lots of investors wonder how it affects the overall market in longer dated volatility products, say more than 30 days, as in a sense, 30 days is not a very long period, only if you compare it to 0-day, so to speak. And sort of the longer dated vol products and the VIX, kind of just sort of summarizing what you see, what you continue to see, or maybe you're seeing something different since we last spoke a couple of months ago in terms of their impact on what's going on in your markets.
Yeah, 0 DTE is a magnifier, right? We don't need to turn it into anything more than it is. It is the exact end of the distribution where the size of the gamma and the effects per, on a daily basis at that moment are greater than any other product, right? And because of that, it has the ability to dramatically reduce and increase volatility. And so what that does is it changes the distribution of how these things move. They become much more disjointed. And they can be at one point very, very, volatility can be very pinned. And then once volatile events happen, it can become very volatile. So that magnifier, I think, is the key point. Right now, everybody kind of sees that as, 0 DTE are vol compressing, right? But it is as equal parts volatility increasing in the right environment. And it just creates fatter short-term tails. Now, to be clear, that doesn't mean it increases long-term tails. I said short-term tails. And we've talked about this. There's been a decent amount of movement from more 30-day type hedges to 0 DTE, even 60-day and 90-day to 0 DTE. And we've said this before, but there's a reason the words long-term were in long-term capital management, right? Long-term capital management was a problem because they were stuck in assets that were marked to market that just got worse and worse until the losses were so big that nobody could get out. 2008 was a great example. The big problem in the bull markets then were variance swaps out 5 years, 10 years, right? And people were stuck and the losses became so big because the amount of vega in it that they went to, incredible, I think it was 10-year vol traded over 60 implied vol. at the end of in March of 2009. So the good thing about open interest in those things moving to zero DTE is you can have a very short-term crisis, but if there's less of this other exposure, structurally maybe there's less, bigger potential for an implosion in the vol market longer term. So really, again, it's reflexive. The more open interest there is in zero DT in the shortest time frame, the quicker a move can happen, the more likely you are to get a very short-term crash. But because it wipes off, comes off the table the next day and is resolved, you're less likely to have a bigger, longer-term structural problem that then needs to be resolved. You're kind of substituting one problem for another, and you're changing the distribution due to the positioning. Now, the caveat to all that is there may be enough bigger structural issues outside of the bond markets that all you need is a crash in a very short period to lay all the other kind of bombs on fire. All the other hidden malinvestment that we talk about and other issues. If we were to get a 20% crash, right, in a day or something crazy like that, right? Obviously, you would begin to see a lot of the other bigger issues boil to the top, and those could be a bigger problem. So it could be the spark that really kind of like the initial explosion that could set off a lot of other explosions, in my view. But again, that doesn't mean that bigger explosion ultimately, much like it did in those other scenarios I mentioned, comes from or is a primary thing in the market going forward after that initial kind of issue. So at the end of the day, I've mentioned this before, but the biggest risk to zero DTE that nobody talks about is the fact that you can't hedge zero DTE with anything but zero DTE. It's a closed circuit, much like GME was a closed circuit and AMC, is a closed, cycle. When you're in something like that, it is a momentum machine by definition, and it just takes one big trade to cascade something. And the CBOE has been very vocal about how well things are very balanced in the zero DTE market. They're consistently balanced. They're consistently balanced because market makers have to hedge zero DTE with zero DTE. And the real question is, well, what happens in that period where it's imbalanced and they can't get it back? And that's a big threat. And so that's how we need to think about zero DTE. That's the reality of what it is. It's not as simple as, it's vol compressing or it's vol accelerating. Right now it's vol compressing because that's working and it's kind of a closed loop and that works that way. But it can very, very quickly be the exact opposite of that.
Okay, 2 follow-up questions there, Jim. First of all, am I right in saying that zero DTE, you don't actually even have to margin your trades because it's happens on the same day, on top of, as you said, you can't hedge it?
You are correct. That is officially the regulatory line. They are making changes as we speak and starting to do intraday margining. They only do it, though, in the middle of the day. So again, it's very disjointed, right? Now they've kind of cut the problem in half, but it's still a big problem. Like,
at least you have to be solvent at lunchtime, right?
Exactly.
Okay.
Exactly.
Fair enough.
So
the other thing that sort of kind of springs to mind when I hear you talk about this, and I'm not sure I fully understand all the consequences. Obviously, it's not really the market that I operate in. But so a few years ago, vol funds became very popular. Back then, it was probably more long vol, but obviously that was after the short vol funds blew up. Then long vol funds became popular, and now, of course, you should have just kept selling options and you've been fine. But I guess what I'm trying to ask you is that at least what I thought of being kind of a normal relationship between, say, VIX and S&P, which I think to a large extent you could say existed for quite a while. That seems to have changed from what you say, in the sense that sometimes it can be compressing, sometimes it can be, increasing volatility. So because we now have these instruments, could we even talk about the fact that things will never be normal if we define normal as prior to 2 years ago or something like that? Is it a new normal? That's a popular term.
Yeah, I want to say something that, you hear all this talk about, is the VIX broken? And that's basically what you're asking.
Well, the correlation in particular.
That's what they mean.
Yeah,
right?
just
when
to make sure. People understand
right?
it. Yeah.
Absolutely. And my answer to that is the VIX was never right. The VIX is a very poor measure of market dynamics. The reality is vol going up into a decline is something that should happen after a certain breaking point in the market. Right? If the market does go down by a certain amount, right, then vol should go up. Similar to actually if the market goes up by a certain amount, vol should go up. So it's really this issue of skew in the marketplace. And there is structural reasons for skew based on supply and demand. The whole world is long. We've talked about this a million times. But then there's the realized historical move in vol, right? It's like, what should it actually be worth? That's a different question than, supply and demand. Did supply and demand dictate that it should be priced where it is? And what we've seen really for several years now is that, market moves up are often more volatile than market moves down. And on a realized basis, if you look at more recent data, there's no real justification for skew on a historical basis, right? On a shorter term look. The reason that it exists, again, is because the world is long, and ultimately the real tail that everybody, where there is panic, everybody knows, look at 87, look at all this other thing, is the downside, right? That's a place you can lose all demand, right? You're never going to lose all supply because people are long. At some price, they'll always sell on the upside. But the point here is that realized vol has changed dramatically. A lot of that is due to the gamma effects from calls and people speculating in calls and the squeezes that we see there. A lot of the other embedded structural reasons that markets tend to go up and they can accelerate up. And we're in an environment where I think there's more, efficiency to some of this, right? And those things make it so that when the market goes down, the vol doesn't actually go up despite it sliding. That, though, has also been more a function of people being hedged more, right? Paying more attention to these risk factors, people using options more. And that hedging, which comes and goes, as we've talked about, has led to vol compression on the downside and the VIX not working as well. So some of it is based on the time we've been in. Some of it is based on structural secular trends. But we've been in a particularly kind of 2-3 year period where it just doesn't pay to own skew. And that just means that the VIX doesn't work like it used to work. And it shouldn't, because it's not profitable, right? To own skew. I talk a lot about fixed strike vol, right? And I think that's such an important thing for people to understand, that the VIX is a measure of floating vol. It assumes that all options are priced the same. There is a natural skew, right, because of supply and demand in the market. And selling that skew has been an incredibly profitable trade in recent history. It is not always an incredibly profitable trade. It is a carry trade that works very well in 95% of scenarios, but in some slow single digit number of occurrences blows everybody up, right? Much like most carry trades. And we haven't seen for a very, very long time that blow up, really happen. 2020, I take it back, not a very, very long time, at least since 2020. And so that is, instead we're seeing fixed strike vol come down very consistently to the downside and be more increasingly supported to the upside as well. So a much more real path that is flat. And that's why you really need to understand and look at what's happening to fixed strike vol and what that means broadly. The fear index, that label for the VIX has always been wrong. And the real fear index is fixed strike vol.
This was awesome. I appreciate that. Great stuff. Now, you just mentioned that it's been a few years since we had a big blow up, but I think the next topic that we're going to be talking about could be the one thing that could actually bring us back to that period of time, because we are going to talk about something that we've talked a little bit about in the past, but when we try and look into the crystal ball. And of course, in 2024, it's not just a normal year. It's a year where I think, and this is probably from things I've heard, that there are more elections around the world than we've ever seen before happening at the same time, or something like that. But in any event, one of them, and that's a very important one, perhaps the most important one, happens on the 5th of November, and it's, of course, in your homeland of the US. So you have looked at this topic. You mentioned that already in our introduction. So I'm going to give you the stage and talk a little bit about some of the findings, and then I will come back with a few curveballs for you.
Yeah, I think the big idea here, and I've talked about this, but not enough, right? This is something that as we move forward here into March becomes increasingly top of mind, is that we're in a very populist wave, right? That's the core underpinning reason we believe we'll have secular inflation and structural inflation. And we've been saying this for 3 years, right? It's something that is a core thing that people aren't understanding between kind of core and structural inflation and those pressures, right? Where inflation is becoming untied to a great extent from GDP specifically. And because of that populism, we see during other periods like this that we've seen, when we'll take the 60s and 70s as a proxy, we've seen a lot more government involvement, right, during those periods, and a lot more importance to what government's doing during those periods. When there's populism and people want to, have a rebalancing of inequality and all these things, things don't come linearly, right? In 2020 was election year. Guess what? We got a massive fiscal response. Everybody will put, will earmark COVID for that, right? But the reality is, if that didn't fall in an election period, we probably wouldn't have gotten as much fiscal response. And I think that's an important thing to understand. So if you go look at the last periods where we saw populism during election years, again, everybody broadly knows election years are positive for markets. It's you want to be very careful in those periods, but they don't really dive below the surface and think about what type of election years are more, are better and more productive for markets. And, we've often talked about the 68 to 82 period or 64 to 82 period, and talked about how markets nominally went nowhere, and the S&P went really nowhere 14 years, lost 70% of its value in real terms. But if I told you that all the elections during that period were positive, and not just positive a little bit, like they were all more than double-digit positive, that'd be kind of eye-popping, right? Considering that the market actually went nowhere over that whole period. And that's exactly what happened in the US starting in 64, 68, 72, 76, 1980. Every single one of those years was a positive year. And the average performance in those years was 20.56%. Think about that. In a period where the market went nowhere. You can take 64 out, still, you've actually even higher than that average performance. I'm just trying to get a broader data set during that populist period. So populism tends to lead to fiscal spending. It leads to fiscal spending, not linearly. It leads to more fiscal spending in those election years because the electorate, is voting. And guess what? The people making the policy, set the bacon on those years. So 100% of the years, 20.56. In the other election years, throughout the whole 1926 to 2016 was the data set we were looking at here. But 2020 was a positive year as well. All those other years, the returns were 5.7%. So not nearly as positive, right? This is talking about the whole data set. You take these little populist periods out. Yeah, it's positive. It wins a little below average positive of all years. And it wins kind of at a regular 75%, a little bit higher than average there, but very ho-hum years. And I think that's a big point. Populism is important and elections are important when populism matters. That's the big takeaway for me. And guess what? We're in a very populist period. 2020, even though it was volatile in early March, was a very positive year. That was still up 21% for the year. People forget that, right? Almost in line with that average of 20.56 year. Here we are going into election year. People are like, we can't go any higher. Well, it's a real thing. And it's not just a real thing because it matters broadly. It's because this is the year you're going to get a lot of fiscal spending and a lot of things that are that are likely to goose the market. And you could argue more than most because it's a particularly contentious year. The other thing I'll highlight during this period is very few 8-year presidents, right? During populist periods, you have a lot of turnover of presidents. Why? Because people are unhappy. Populism is kind of a disgruntled time. People aren't kind of kumbaya coming together. People, being an incumbent isn't necessarily as much of an advantage as it is during other years. We had, Johnson, Nixon. Nixon was there for 2 terms, kind of, because then he got kicked out otherwise, right? And then we had Carter until we got to Reagan, right? And so it was a very, if you look at history, it's an outlier in terms of, 8-year sessions, very, very, very few. So that's also not kind of...
Question for you. Does it matter whether it's a Republican or Democrat that wins for the markets?
It does. Republican years tend to be more positive broadly. If you look at this populist period, though, Nixon and Reagan, I guess, being the 2 positives, it was just slightly more positive during this period. During Nixon, it was an average of about 15% as opposed to 21, we were saying. And during Reagan, the one election we had for Reagan during that period was 32%. So I would say at the end of the cycle, when things are ready to kind of start, when you have an ability to come in with supply side economics like Reagan did, that's a very positive. And that's a very positive going forward as well. The question is, are we about to enter a supply side driven Republican presidential cycle? I don't think Trump is that kind of, we'll see. Maybe it is. Maybe, and that's what people are hopeful for. If he's a true Republican in that sense, it's positive for markets. But if he's a populist president and we're talking about more protectionism, and we're talking about more labor rights and pandering to the rusted out cities in middle America, maybe he's actually a Democrat, right? And so those are the big questions. But if you look at the data, it bears out that, supply side economics is better for markets. Doesn't mean it's better for the people, it's better for markets. And the returns rationally play that out. But election years also rationally play out that there's more spending, and that cyclical support in these periods is very, very positive. And that's, the data speaks very loudly here if you look at it closely. And I just think that's very, very important to understand.
You mentioned, Jim, that during this period there was a lot of turnover in terms of presidents. Let me throw in this curveball that I mentioned. I wanted to bring in the third candidate that nobody talks about, and that's Robert F. Kennedy Jr. And again, I don't know the technicalities, whether he can just actually get on the ballot or not, or whether, I don't know. But I was listening to a very recent podcast with one of our previous guests, Pippa Malmgren, who is, of course, incredibly well connected into the world of U.S. politics herself and also her father. And she was saying, and I have no reason to doubt her, but I don't want to make it political. I also want to make sure that's clear. But she was saying that Robert Kennedy is polling incredibly well. In fact, that some polls that she tracks have him neck and neck with Biden and Trump, and that he's drawing about an equal amount of voters from Trump and Biden. Now, she's saying, and again, I don't want to make this political, but she's saying that one of the reasons why we hear nothing about him in the press is that he has been very vocal about the fact that if he wins, one of his strong views is that pharmaceutical companies will be banned from advertising, which, by the way, is the norm in most countries except for the US and New Zealand. So that doesn't strike me as a very radical view, but it's radical if you look at it from a network point of view that is being funded mostly by pharmaceutical companies, I guess. Anyways, so she goes on essentially to say that the real risk that she sees is that you could end up with a hung electoral college because, according to the US Constitution, you have to get 270 electoral college votes in order to become president. But if it's a pretty hung race between three, none of them may get to that number. I don't know. I mean, you're obviously closer to this than I am. I don't know if you have an opinion. I don't even know if you want to speculate about if that really was the case. What happens from a volatility point of view, and so on and so forth.
Probably net positive for Democrats if that was to happen, because ultimately the way the system works is it forces a coalition, right? I think there's a better chance of a coalition on the left than there is on the right. So I think that would be my biggest takeaway. I do want to make a bigger statement that's specific to the hung,
okay.
And that'll create, trust me, a lot of turmoil in between. There will be, no matter who wins this race, there are going to be some very, very unhappy people. That's just the water we're currently swimming in. We've been talking about this for like 4 years now, that this is going to continue to be the case. But I think the bigger, more important thing that very few people are talking about is, again, if we go back and look at this history from the 70s and 60s, you have, until Reagan, you have a very young, starting with Kennedy, you have a very young kind of vibrant kind of politician relative to history. Enter the populist periods, which is where's the populism where you and I have been talking about coming from? It's coming from millennials. It's this wave of, it almost always does, right? They're the labor and the distribution that eventually says enough is enough. I've gone through 40 years and, I'm dramatically underperforming. That anger, that vitriol, not to mention that energy that comes from that grassroots political movement from the youth is what generally drives these cycles. And so that tends to drive younger politicians. Right now, we're sitting at, the oldest two kind of combined, ages of candidates we've ever seen. And it's both sides don't like that, right? It's not a one-side thing. So we're definitely setting up for a young political person to come in and speak a different language, right? Speak directly to this populace. And that's what Robert, I think you can argue a lot of other things about his brand and whether, it fits or it's popular. It's not really him, if you ask me, right? He doesn't speak particularly well. You can go through all the aesthetics and policy things, but what he does well is he's young and he speaks to the people in a very young, different way. And I think that's what people are. That's why he's polling so well.
Yeah. I would say he's younger. I'm not sure I would call him young, but he's very fit. He's very fit. So we can, he has that on his side. That's
the point, right? Yeah. It's less about age and perception of youth and energy, 100%. So things rhyme again. Kennedy is actually the one who kicked off the populism, right? The reason we had the Great Society program is not because of Johnson who passed it. That was Kennedy's program. It got passed because we had our own COVID, in a sense, our own kind of reason for that populism to take hold, and that was Kennedy's assassination. And that really allowed Johnson to get both sides together to pass a massive fiscal response and get that wave going at that time. So, just interesting parallels, something to be thoughtful of. Again, I think people are like, oh, how can we be dealing both sides? The most popular thing is that everybody agrees that these politicians are too old and they're stuck speaking the wrong language. They're not thinking about things. And the more millennials every 4 years come to political dominance, we're going to hit a tipping point where the vacuum is there. It's ready. Again, everybody talks about Trump as the cause of a lot of these things. We've been very clear. He's a symptom. He was a person who saw the marketing opportunity of taking the right left and really marketing a populist message and was able to capitalize on it. There's an opportunity here. Somebody, maybe it's Robert Kennedy, is going to come in and fill that void. It's a matter of when.
Yeah. Do you already see it in terms of volatility pricing out in around November time? Do you already see some?
Yeah, November's already priced every election cycle for the last several. We've seen increasingly higher volatility price. So yeah, we are already seeing that. In my opinion, it's actually still cheap, but that's a whole nother conversation.
Yeah.
Yeah. But we're bound to get a crazy reaction no matter what happens.
Yeah, no, I think that's very true. Let's stay with the shorter term and then move on to the medium term. You wanted to talk a little bit about the flow as you normally do. What's going on there?
Yeah. And I think we remiss if we didn't talk about March OPEX, right? Here we go into a big quarterly OPEX. We highlighted before the potential at the beginning of this March cycle for a tail risk. The other side of that is, and we were very clear then as well, is that what happens in big open interest quarterly OPEXs is you get a changing of the distribution. The expected values don't move, right? But what happens is the probability of an up move goes up, and the magnitude of the left tail goes up. We saw a crash Fed to March OPEX cycle. We talked about this a bunch, right? In 2020, right? Day to day, it was a 30% crash. That's that fat left tail that exists in big quarterly OPEXs. But if you get past that first week or week and a half, and we've been very vocal about this, you have to be constructive because the last 2 weeks become that acceleration of buyback of all those the deltas against those hedges. And we're seeing that. So this is the whole beach ball underwater kind of meme that I put out there all the time, right? This is the bottom chart flows that accelerate during this period of relative strength. Now, markets are more, these flows, by the way, are immutable. Like they have to come along. Now, markets are more aware of it. There may be some front running of it that happens, et cetera. But these periods invariably end up finding, any sell-off provides support. And that's the part of the distribution that gets muted as you get into these last periods. So there's a lot of delta buyback during this period. Now, does that mean the market's going up big? Not necessarily. If the market's been up big and kind of front run this, and now it becomes kind of beach ball underwater. So the point is that beach ball underwater, that buyback will keep coming. You couldn't get a stair step down, but that volatile move to the downside is going to be very hard as you approach March OPEX because the scale and size of the buyback is huge. The corollary to that, which I think is actually even more important, is that as we go through this period, March, the quarterly OPEXs are very high in pricing because the demand for them is higher relative to the expirations around. So it's a very easy, and most market makers and most people who are warehousing risk will sell that high vol and go buy what's cheap. It's normal, right? You sell what's expensive, you buy what's inexpensive. So structurally, there'll be long volatility behind, meaning in April or in the weeks after, March, against a high March OPEX. Well, what happens is that March OPEX decays and comes back down in blind. They decay longer and longer implied volatility, right? And as that happens, and that's what we call VOMA and VETA, right? VOMA is the what happens to your vol exposure per 1% move in vol. And what happens, VETA is time. So what happens to your vol exposure per move in time? And what's happening is after these big quarterly OPEXs, there's a natural decay longer in implied volatility to the market, to dealers. And ultimately that is vol compressing into that window because every day they get longer vol and they need to sell it, right? So this is kind of, as vol declines and slides down on a kind of a declining kind of contango, it also, they get longer. So all of that ultimately means that you're likely to get some vol compression in these windows, and it's likely to also trim the downside potential with exposure as more and more vol gets sold into these windows as well. Again, this is a very short-term, 2-week, 3-week phenomenon, but it is also what it tends to be supportive. If you get through this window of kind of this February, March cycle where there's weakness, that can be very now constructive again. Vol's well supplied. We may digest this period. Sure, we may go up, but regardless, as you go forward, now you have a vol supply that is healthier and more, allows for a more kind of continuation of a rally. And that's why we've been very clear. Like there was a window here for a tail. We rallied really fast. It was, you rallied over 20% in a kind of a 3-month, 3.5 month window. If there was a time for it to give it back and to get some weakness early in the season, this was it. But if it didn't, right, here you are getting vol supply, and we already talked about the election year, right? So hard time as we get to later in the year for these things to kind of crack. And that's why, you have to start becoming more constructive broadly. And again, that's why these little micro weekly periods actually really matter to the path and what's happening. And you can pick out, okay, this is more likely to be this path now because we've got through this period. And I think that's very important to prediction and understanding those short-term flows. because of the vol compression in the SPX that we're also seeing in this period, we're seeing dispersion pick up again, right? When we were seeing market up, vol up, we're seeing expanding breadth and slightly less great dispersion. Vol compression here over the last week and a half, guess what? Or really 2 weeks, you're starting to see a bit more of that dispersion. We already talked about call exposure in the NASDAQ, right? And the decay of that. Well, if you're seeing that weakness in the NASDAQ, right, on a relative basis because of those selling flows, and vol in the S&P is pinned, well, what's going to happen? You got to see the other stuff start to perform, right, by definition. And not just perform a little bit. And that's what we've seen. We've seen a real pickup in the Russell, a lot of other kind of underloved things that haven't worked for a while because the S&P is pinned and the calls are decaying in the MAX 7. You're really starting to see a pretty serious rotation. Like we mentioned before, that could start to feed on itself, which I think is very important. So that's the short-term picture. I do think it's important to, again, we talked about the election year, but also the more that this vol compression happens because of fixed strike vol, that upside call starts to get really cheap again. So if we fast forward in 2 weeks, you better believe you're going to be looking at a call, 2 months out or a month and a half out. That's 10% out of the money. That's on a really ridiculously low vol, given that realized vol we've seen in this last year, in the last 9 months. And those will become an incredible buy again. And then you'll get to see market up vol again. Is what we're going to see probably after that. So, after this period of compression and kind of digestion and kind of rotation, comes the setup for another market up vol. And the bigger, I want to be clear, the bigger medium term trend in the trade, given the potential upside in an election year like this as well, is to see a real market up vol up scenario that can go on all year. And that's one of the better trades you'll see all year. And so the real trade is to buy those long dated calls and not to hold them short stock on their own, but really fund them with other things that will then get you into cheaper and cheaper calls like that will then pay out as we rally again. And I think that's really the trade and the way to approach it. The Fed has told you what they're doing. They're in a stagflationary, in a box. They don't have many options. They have to choose. Are we going to deal with the inflation that keeps coming in hot? Or are we going to deal with the slowing economy and try and stimulate? And it's all about incentives, right? I think last December they showed their hand, and their hand is, gun to the head. They're going to choose growth in an election year. And that's exactly what the data tells you they do always anyway. And they're going to do it more than ever this year. And that's accentuated by the fact that Powell's job is probably kind of going to change if somebody gets elected. Not to mention that there's risk for the institution of the Fed broadly. And if he's seen as a savior for the institution of the Fed, he's incentivized to choose growth. And an object in motion tends to stay in motion. And that's what ultimately leads to this kind of blow off taunt that we're likely to see. So that's the flows, as it currently stands, short term and medium term, and how I think we need to be thinking about this.
Okay, fair. Good, great, excellent. Now, I mentioned earlier we're recording on the last day of February. And of course, I think as probably most of the people listening to us are aware of, it has been a month where the S&P 500 has not only topped 5,000, it has, for the first time, it has continued to rise and made quite a few all-time highs. Now, with this bullishness and risk on, we've also seen a bit of a déjà vu when it comes to meme stocks, and the shares SMCI, Super Microcomputer, hit a new all-time high amidst a record high in option trading volume around the middle of February. Moreover, implied volatility of that stock or the options with a 1 year expiration has been above 80%. And all of that reminds, I think, a lot of people of GameStop, AMC, and those heydays. What does this tell you when you see this going on?
It's a market that is not balanced at the end of the day, right? It's all about incentives always. If you give people the opportunity to potentially make gazillions of dollars to the upside, and there is an embedded buyer that will protect some of your downside, right? They're going to take it. And what happened with GameStop and AMC and all these meme names before was that the retail investor was so one-sided that there was a lien, and the institutions can push it out in front of them and know that they're still going to buy it, that they were price insensitive. And there's a price insensitivity here, and a block buying kind of mentality that creates a momentum machine. And once that's in place, your odds of winning versus losing on going along are just higher. And it won't go on forever, but it's a good trade, and so everybody's going to take it. And so, yeah, you don't get in the way of that. I think that we saw it in GameStop, right? That story has been well told. Who's going to short that? No one, right? So the trade is to play it, and to play it with leverage, and to take as well take as good, and then once it does finally break and that momentum sheet, when it breaks, to short it. But that may not happen for a year, and so for now, that you don't get in the way of those narrative names. And again, I think the big point, again, to talk about the zero DTE and to tie that in, is when you're on a part of that distribution where you can't hedge that exposure with anything else, really, it can go anywhere, and it can just keep going. So yeah, it's not a fundamental story. I don't think we can look. Everybody tries to put rationality on valuations of these things. I mean, are we going to do that? I mean, do we just watch what happened with GME? And it has nothing to do with rationality. It has everything to do with buyers versus sellers. And that's, once it gets going, especially when options are involved, the amount of leverage and, it's too big, and you get cascades. So if everybody's pushing one way, you better be on that train. I think that's the big takeaway.
If you haven't watched it yet, Jim, the next time you take a flight and they have a movie, which at first sight, when I saw it on one of my recent flights, it said Dumb Money. And I thought, no, that must be one of those silly films. And then I just read a little bit further down. It was actually the movie made about GameStop. And I have to say, surprising, I would say the movie was better than I thought. So I don't know if you watched it. Otherwise,
I haven't watched it yet. I'll be flying soon, and I do intend to watch it. But it's just a great story, right? The whole thing's a great story. It's but it is almost like Dumb and Dumber in real life too. So they're it's just but there's a reality to this, right? And that's what people are figuring out, that you can get together legally with other people and just say, hey, we're doing this, and go and just push it, and at that point it's a supply and demand imbalance, and it's a momentum machine. And that's what happened, and that's what will continue to happen unless the structure of the regulators change something.
Yeah. Speaking about supply and demand, U.S. debt. You wanted to talk a little bit about U.S. debt, what you think might be coming, the impact on the dollar potentially. But clearly there's a lot of supply of that at the moment. There seems to be okay demand for it still. But what are your thoughts on this?
Yeah, we talk short-term flows, we talk medium-term flows. And let's talk a little bit long-term, right?
Great.
I think one of the most controversial things that I'm saying out there publicly, and that most big investors are completely out of line with, and most people absolutely despise, and I get the most hate mail about, is my point that in any reasonable amount of time that matters, meaning 20, 30, 40 years, the U.S., ultimately, the U.S. debt doesn't matter. Everybody's pointing to that this cycle is different because the U.S. has unsustainable debt, that they can't allow interest rates to go higher. My view is, all you have to do is look at what Nixon did in unpinning us from gold in 1971 to see that the value of the dollar has nothing to do with its, actual fundamental value, and it has to do with power. If you were to go analyze that period very closely, what you'd see is that at first everybody said, oh, wow, the U.S. is stuck. They're unpinning the value. They have to basically devalue the dollar. And for a second, the dollar got really, really weak, and then it rallied. And it, relative to the price of gold, it was a massive bullish trade. And that was the first debt jubilee we really saw here. Like I guess to date, the only real debt jubilee we've seen in the U.S. Well, people don't call it that. That's what it was. That moment is so important because it created the fiat world that now allows the Federal Reserve to be dominant. And it's what created the last 40 years, the ability for the Fed to be so dominant, create the last 40 years of a monetary policy cycle and the inequality and everything that we've seen. But it also made very clear to everybody that power is all that matters. The exorbitant privilege is quite simply the fact that, if you're powerful enough, you can tax much like kings and queens. And again, very unpopular. Feels awful for me to even say, right? This isn't specific to the U.S. It's specific to every other country and every other place in the world since time has begun, is that you can tax everybody however much you want because you protect them, because they depend on you, because they get to play in your economy, every single reason. Now, eventually, right, that people become sick of that, and eventually they get together and they, if you're not being a good benevolent dictator in some way, right, they come and kick you out. But in history, at least, there's no real example of that happening overnight. Every empire since beginning in time has kind of faded into obscurity until there was a clear alternative. And then that power struggle kind of, they coexisted, and then the other one kind of went away. And that happens over the course of centuries, if not millennia. And so I think to sit here and say, oh, the end of the dollar is nigh, this debt is unsustainable. I think it is, there will be a point, to be clear, where the incentives are to another debt jubilee. That I believe 100%. But the consequences of it will be almost nothing, for the United States at least. The consequences will be what the consequences were when Nixon took us off the US dollar. Gold, sorry, I took the dollar off gold. It will be that the dollar will actually rally. The dollar will ultimately rally when we hit the button, when the Fed goes, we're buying all the debt, beep, and the debt's gone, the dollar will rally. That tells you all you need to know. And we know that also from just looking at Japan. They did it much slower because they're not the U.S. They were backed by the U.S. That's where they were able to do it. But they monetized their debt. We don't look at their, 275% debt to GDP, because it doesn't matter because they own their own debt. They will eventually beep, hit the buttons, and it will go away. So I think that's the big takeaway. And I think all the talk about that, I think, is in the long run overdone. Now, we will get a ton of volatility between now and then, because not everybody thinks the way I do. There is a lot of players who it will be clearly when that debt jubilee, which I think is inevitable, eventually comes, which could be in 10 years. Who knows what the time frame is? It will be very volatile, and the time between now and then will be very volatile. That's what happened with gold. We've talked about that during the 60s and 70s. Gold was the best performing asset, period, but it was incredibly volatile. And the reason of all these things is because of the Fed being in a box during that time, the changes in the debt jubilees that happened, right? All the things that we talk about. And that's, I think, where we're heading broadly again. This time, you need to throw another name into that gold kind of bin, and that's Bitcoin. And the reason you need to throw Bitcoin into that bin is because gold is just based on what people value it. And Bitcoin's just based on whether they want to buy it or not. And the entity that we keep talking about, millennials, who are driving the political force that's behind this, they like Bitcoin. It's that simple. They see it as a store of value. So in the short term, is it a surprise that there continues to be more introduction of infrastructure and, more listing of accessibility, which then brings in more volume and that leads to higher prices? Yeah, no. But you better believe it's going to be very volatile on the way. And I expect both gold and Bitcoin to be very good performers in this period, but very, very, very volatile. And the way to play it, as we've been saying, is to own calls in these and these products, regardless of how expensive those calls are. They will continue to print, and they will continue to give you the ability to add into the volatile pullbacks, which you'll also invariably see. So I think whether you believe in Bitcoin long run, I think there are massive structural headwinds. We've talked about that on here to Bitcoin over much longer periods. I think eventually government will, much like Nixon, got rid of gold, not allow themselves to be hemmed in by Bitcoin, and they'll have a certain amount of activism against some regulation, which I think will hurt its value long term. But that doesn't matter. Much like we're talking about meme stocks, if there are more buyers than sellers, get out of the way.
Yeah, it's interesting. You just threw in the word Japan there in your comments. That was actually going to be my last point, because I wasn't quite sure where you're going to go with the US debt, et cetera, But of course, Japan has been a big buyer of US debt and other debt, including and of course their own as well. But I did notice again in a headline from Bloomberg this morning, actually, that one of the BOJ people, Hajime Takata, I think he was called, that he has sent a pretty strong signal for the case of negative interest policy coming to an end in Japan, and maybe even as early as April. And of course, that is interesting because of their status as the largest creditor nation in the world, because at some point, maybe they will simply find enough yield, as low as it may be, but enough for their purposes in the domestic JGB markets, which they haven't been able to find for a very long time. And of course, this month was also, let's not forget, the year where the Nikkei came out of a 35-year drawdown. That's pretty amazing.
Yeah, it's been a wild, this is the Japanese market, for us. I've been in this business for 25 years, has been kind of everybody had to give up on it. It just got so bad for so long that nobody wanted to even watch it. And then, except for Warren Buffett, what timing, but yeah, I mean, look, this comes out of a bigger macro framework as well. If China's been the trade for the last 40 years and Japan's been kind of hurt by some of that ascendancy in other ways, right? Not to mention having to work through their own debt and everything else. What happens with the move away from the connection between China and the U.S.? There's a need for China to also move towards technology because they're losing a demographic edge. And there's a vested interest in the U.S. and the West to broadly support Japan and support its economy, militarily, all the things we've talked about. And I think some of the power is power at the end of the day, and countries in power tend to outperform once they come out. And there is a vested interest in the Western world to support Japan in this current regime and as a source of power. And so I think Japan, having now gone through and monetized the overwhelming majority of their debt, sits in a much more kind of healthy position economically, and now is also getting a lot of tailwinds. So I think it's a great story, and I would argue that it's you have to be kind of bullish of that trend, despite valuations or anything else you look at. Correct. It has a lot of tailwinds.
Speaking of power, I actually started listening to one of our previous guests that you and I spoke to a while back, 2 years back, Peter Zion. He came up with an updated version of one of his books recently. I'm working my way through that. Oh boy, there's definitely going to be some countries with a lot of power, and there's going to be a lot of countries with very little power, according to his view. Let's hope maybe Cem and I can get him back to talk about that. You and I actually are going to also be talking in the next 6 weeks. We're going to be recording with a couple of previous guests, and that's more in the global macro world, and that's going to be super exciting. So people should pay attention to when they come out over the next 6 to 8 weeks. Jim, this was amazing, as usual. Anything you want to leave our audience with before we wrap up? Or do you think we did a pretty good job sticking to the talking points
I think we covered a lot of great points today. I think the last thing I'll say, I'll touch on what you just said about geopolitics. We've kind of stopped talking about geopolitics, much less in the last 9 months or so, right? There's just as much going on. We're just talking about it. But I would say that some of that is because of the duplicity that comes naturally during an coming election cycle. People are kind of a wait and see mode. Nobody wants to make any big moves, but until they know who's going to be president or what's going to happen. I do think 2025 is going to be a very geopolitically big year, not to mention a big year for market volatility. And so we've kind of talked through the election year. We haven't kind of given any hints as to what lays on the other side. But I think it's important. I think when you say market up, ball up, and all those things we're talking about this year, the reason you do that as well is because 2025 sits out there with a big potential fat left tail. And whether that move begins to happen in late 2024 or really more likely in 2025 itself, I think you kind of start preparing for that into this bull market that we're likely to see this year.
Yeah. Well, that is definitely a teaser and a reason for people to keep listening. I think what's coming in the next many months will be eye-opening and hopefully help people navigate what is definitely a fourth turning that we know is not going to be over anytime soon. Next week, I have Rob back, so that's going to be fun. Different topics, of course, but no doubt there'll be some thought-provoking stuff. If you have any questions for Rob, feel free to email them to info@toptradersunplugged.com. If you enjoy these conversations in general, if you want to say a big thank you for Cem for putting these talking points together, go to whatever podcast platform you prefer to listen to and leave a rating and review and a hello to, or a thank you, I should say, to Cem and all the work that he puts into this. From Cem and I, thank you so much for listening. We look forward to being back with you next week. And until next time, take care of each other and take care of yourself.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.